Welcome to Momentum Monday. Today is October 30th, 2022. Howard, what do you think about the market here? Are you still bearish? Are you getting more bullish?
I don't like the term bearish, but I think I'm like, the tape is telling me. Well, first of all, I feel like, the market's doing what it wants to do, right? Like it's rotating. There's the fear is dropping. It feels like if we're going to get back above the 200-day or at least touch it again, this is the right time of the year. You've got, I think you've talked about this. The banks weren't great numbers, but they went up. The tech, other than Apple, weren't great numbers and they went down. I think we're very clear on the fact that the tech run has changed, meaning like people realize that these companies have too much power, not just because of the power over the customer, power over their governance, and no one trusts management at these tech companies, not because of the user anymore, or the government, but because they've run these fiefdoms that just overhire. So I think the Elon Musk news, whether he runs it well or runs it bad, the fact that there were 7,000 people at that's the meme, that's the joke. But the joke's also on Elon because he paid all those people top dollars for their stock to leave, right? It's just such a weird moment in time where the employees are writing open letter and they should be so thrilled that their stock isn't valued where Facebook and Snapchat is at Twitter, and they should be thrilled to mark up their LinkedIn resumes and go take their bad whatever thing they learned that are useless to their next company on the road. So I think tech, we do have this period. I'm going to take a lot of heat for this. What's the closest thing about this to 1999, 2000 is the aftermath. Okay, so forgetting rates, forgetting prices, who cares? It's going to be more like a 3-4 year period of underperformance for tech. Okay, and because the Fed is much closer to changing stance than they are to beginning stance, again, it could be 6 months or a year, there will be more bubbles, but we're just not going to see the bubbles like we saw. This was a market bubble, whereas 1999, 2000 was a tech bubble. What we've had since 2008 is a complete everything bubble, right? And so you're going to have to be a very good asset allocator, and it's going to be very tough. But I do think the S&P short term over the next month should be able to get back above the 200-day moving average. And I do believe if it's a true bear market, and maybe we go to 420, 430 and suck people back in for another leg down, because, deglobalization, the market sizes are going to shrink, period, end of story. And so you can't have the same valuations, especially with rates not being at zero. Just math, not because I'm bearish or bullish. So that's where I stand. Within that framework, what do you see?
Yeah, in the past few weeks, we're definitely seeing improvements in overall market breadth. We're seeing a decline in new 52-week lows. We're seeing the new 52-week high list expanding. There are various industries. I mean, just last week we saw McDonald's.
Yeah, didn't see that coming.
LMT, which is a defense company, NOC. A bunch of others, like Caterpillar is not too far from it. Like they gapped up on earnings. So quite a few, other than tech, quite a few other industries have been really being.
A couple things I think look flashing through is Amgen, Vertex, and Bio. Even though the indexes are struggling, Amgen all-time high.
Exactly.
And we were talking about 80 points. This stock looked terrible.
Exactly.
Amgen, and so it just snuck up. So the good news is, if the S&P goes sideways up for 3-4 months before going down this next time, there's going to be a lot of stocks that double, and it's not going to be the Facebooks and it's going to be some other sectors. So you got defense, you have drug companies too that broke out. And I don't know if they can double wow Gilead. And then there was Vertex as well.
Yeah, they're volatile for sure to hold them, but the overall trend has been higher. Yeah, I mean, definitely market breadth has been improving. The market basically survived bad earnings from 4 of the biggest companies in the world, Meta, Google, Microsoft, and Amazon, and the market didn't tank. Actually, the S&P and the Nasdaq 100, they were green for the week, which.
But you're not going to make your money down there. So where you're going to, like what I would do right now, I'm running some scans, is I'd look at 52-week highs in like energy. I guess tech, because anything leading there in biotech, in defense, and drugs, and just put a momentum portfolio together with an allocation that says, listen, if we're going to have a rally for 3 months, this group should outperform. So it's very hard because these are new groups. Like if you've been in tech for 10 years, it's hard for me to learn. So I'd have to buy a basket of them,
Yeah, sure. That's one approach. And I mean, let's not forget, FOMC meeting is this Wednesday. And I mean, some say that the market is betting again that the Fed is going to say something that down the road they're going to pivot.
They're just not going to say anything because the market's already priced that in.
I mean, other central banks have already shown some signs that they're ready to pivot, like ECB and the Central Bank of Canada, of Japan, of Australia. But the inflation continues to be very, very high. And all those processes that you mentioned at the beginning of the show, deglobalization, just build stuff in America, all those processes are going to lead to more inflation. So more and more reason for the Fed to continue to raise. And when interest rates go up, valuations go down. And obviously tech has been hit the worst lately.
As they should. It's growth. And they've had such growth in so many years of like neglect management. They've bloated their teams. And, there is so many of these companies refuse to let go people because they have good cash flow and they believe they have to invest in R&D and they have lifetime governance where they can just be CEO forever. And guess what? The market's voting, saying you may be right, but we'll go buy a drug stock or the S&P while we're waiting.
Apple is the only one that is holding, even though below its 200-day, overall it's holding really well. Like I posted a chart last week when I showed all the mega caps. Apple was the only one that was kind of flat for the past year, since October of 2021. Everyone else was down between 30 and 60 or more percent.
But you're not going to get great returns there. So if you believe there's going to be a 3-4 month bull market, what I'm saying is you got to go to you got to go buy the dips in these new breakouts, because there are a lot of them. Like I'm sure you can post, meaning there is some hint that people are willing to take some risk on the edge. But for me to pick those stocks, because I'm so new, I have no time to like study these companies and see how real this is and what the valuations are compared to historical. I don't have an edge in trying to pick those. So if you're really trying to build a portfolio, it's hard right now because, you've been hit really hard by owning a lot of, last term's winners, It's becoming clear to me, obviously, who's going to survive in Web 2 and who isn't. And those companies are going to be massive. I saw Robinhood. Remember we talked about Robinhood. It's starting, closed at a weekly. This could all be false moves. But if I look at, they're a derivative of a bank, and those stocks are strong. Look at Schwab closed at.
Schwab closed strong. Interactive Brokers also super strong. So the whole sector is.
Really so I'm saying, like the good news is a lot of boring older companies are showing strength. The bad news is people are still over allocated, including me, to tech. That's just very hard to give up on something that worked for so long. And that's the problem. The opportunity for investors that listening to this is you can go try a couple of new sectors, or you can try to put together a list and build your, allocate 20-30% to this new areas of momentum, knowing that if the market reverses quickly here, those are going to get pounded right back into their bases. Or you can really say, listen, I'm going to take tech, I'm going to take beaten up tech, and I'm going to hold it, and I'm going to put 20% into beaten up tech starting this week, and look for, companies where the founders are leading it. There's a lot of overhang on these companies, and ride it for 4, 5, 6 years for the next cycle. Which is what I'm doing with the small, but I'm not adding to these anymore. I've picked my companies like Netflix, and I'm not adding, and I may be tempted to sell some along the way. What else? So how are you playing it right now? Enough about me. I'm done. So
yeah, I'm doing short-term trading as usual, and it's earnings season, so I'm playing the earnings. Every day there are at least 3-4 really good opportunities like to trade in companies that report earnings. So you can trade the first day, and then you can trade the second day, the continuation. That's what I'm focused on, really short-term trades based on earnings, companies that just gap up or gap down, and I'm just riding the momentum. I just find a really tight stop place to enter, and that's what I do. Just take a few earnings trade every day, just based on earnings momentum. That's what's working currently, really.
Yeah. Let's pull back up the S&P and the 200-day. Yeah, I really hope. I do think there can be a nice. But then you got the elections coming. Like I got no feel. The elections are coming up, and I have no idea how they're going to go.
Yeah, right? Next week, or next. Next week. 8th.
So I'm hoping that we don't get too crazy straight up, because the market has no reason to do that. But I do feel like we can. And again, I don't know if it's good or bad that we're going to recapture that 200-day in some kind of meaningful way, and suck in a lot more people.
Or the Dow Jones is already there, despite the fact that they actually dropped the XOM, which is basically tripled since they dropped it from the Dow.
Yeah.
Replaced it with Salesforce, which is down 50% since they got it. So despite of that, the Dow is back above it's still declining.
Yeah, but still back at, still back, not much improvement since 2019, so again, it's back, but it didn't have the run, you know what I mean? And well, it did have a great run from the lows, but yeah, it's underweighted to like the true, it's just been the toughest year for me. It's just.
What's your take on Coinbase here, as right in front of their earnings? Cryptocurrencies have been rising lately as a risk on asset.
I think it's a derivative. It's if people want to own crypto, it's the way to own crypto. The crypto to me is still not proven. You have all these high valuations of a lot of smart people focused on problems, but not enough users, right? And so if crypto is just for investing and trading for the next 3-4 years, the easiest way versus you buying Bitcoin or trying to pick the currency is to own the derivative of it. And Coinbase is that way. You can see it hasn't been great, but I do own it. Just like been buying Robinhood down here. Is that that is my way as a proxy on this next generation investing. Picking the actual coins themselves is still like, too hard. So yeah, I have no edge on where that's going. It's very hated. It's very esoteric. It doesn't feel like the government cares about regulating it because of, so you've got this kind of like overhang that nothing will happen good. But it's just, I just have never seen it so hard. But for those people that switch to energy, those are the people that, buying stuff out of favor, like XOM, when they get kicked out, where we're going to see Facebook get kicked out of indexes pretty soon. It's down to 1% of the S&P, Facebook. So You
I
know,
doubt that they're going to kick it out. It's still a pretty big.
no, but
company.
you know what I mean? It's down to 1%. You know, this, you know, he sounded pretty unsure of himself. So if you're going to buy, the reason I own Netflix, not Meta, or bought more Netflix and not Meta, is because Reed, it was hated for the wrong reasons, right? Reed is a great executor, and he doesn't have this power to like stay as king forever. So when he really understands risk reward and really has executed over the years of the public company versus Facebook. This is that moment, you know. In Facebook, if we pull up Facebook stock, he wasn't that sure what he was doing was the right idea, you know.
Maybe they're too early with all the metaverse, but we'll know.
Metaverse is stupid. The metaverse is stupid. YouTube's cool, AI is cool, augmented reality is cool. Strapping on goggles to participate in a world that is not as good as the world that exists with your two eyes is a stupid bet. It's a great product for people that like to game, okay, but that's it. It hasn't, you know, so there's no one clamoring for this product, and it's very expensive, and it's full of all kinds of weird, you know, things that you have to do in order to enter it, and the reward's just too good. So listen, maybe things turn, that this isn't like buying Exxon when it got kicked out of the Dow. This is not the same thing. It was almost funny that the Dow kicked it out, right? It wasn't for any reason other than they just, I forget their reasons, if it was market cap, but Facebook isn't like that. I think the tech people that really focus on what the Wall Street is asking for in terms of governance and in terms of, you know, lowering burn, or lowering, you know, increasing margin and lowering burn. Exxon is a function of lack of investment in the space and them having pricing power with, you know, the commodity and the leverage. The commodity is moving in its favor, and they've got leverage, you know, from them not spending. And then you have, you know, the fact that energy was 4% of the S&P, and if people aren't scared in terms of pulling money out of the market, it's just going to rotate into this sector, which it's doing. So you're getting kind of just an appreciation phase. Picking the winners within those companies comes down to people who really have experience and have been through a few of those cycles. That's not me. So I've been using XLE for the last few months, and it's working, but not at the size that if I got the right stocks right.
Yeah, I mean, solar is also back. ENPH beat earnings estimates, gapped up, acting constructively.
Right, but for all the technical traders, Ivan, they're getting killed here, whipped around, because they don't know the story and they don't understand, right? So if we're at the beginning of a bull market, this is great. It's shaking out all the people that are technically trading it, and the next move could be real. But like, it's very hard if you don't understand the company to be able to buy the dips. And so you've got these weird price action in a lot of these solar stocks, because no one really understands the fundamentals. And that's just because the trends have just disappointed forever, so no one's really done the work. So that is the opportunity for people that want to learn new subjects: solar, nuclear, biotech, climate, you know, new forms of tech. Now's a great time, because no one's making money, you know, this year. So this has been a good time to invest in, you know, kind of being an expert in something. All right, I'm going to hop. I've been rambling. I hope it's going to be an interesting week. And then, I mean, what do we got this week? The Fed?
Yeah, FOMC on Wednesday, and then I think next Tuesdays are the elections. So probably the next 10 days will be a bit more volatile than usual, and obviously still earnings season, so plenty of catalyst to move stocks. Any
big earnings this week, or are we all through them?
We are at the very beginning. I mean, I think NVIDIA still needs to report. There are quite a few companies that remain.
Yeah.
Oh, no, NVIDIA is 11/16, so there's time.
Okay.
Plenty of companies, hundreds of companies. Okay. All right, Howard. See you next week.
See you.